This credit is for care that lets you work or look for work. That work-related requirement is the gatekeeper. If the care didn't free you up to earn income, it's not in. Also, on the EA exam, watch the trap. This credit is generally non-refundable, so it can reduce tax to zero, but it usually won't create a refund by itself. Next, you need a qualifying person. The big one is a dependent child under age 13, measured at the time the care is provided. The other big category is disability, a spouse or dependent who is physically or mentally incapable of self-care, any age. And there's a special twist. Someone can still be a qualifying person even if you can't claim them as a dependent solely because their gross income is too high. Now cap the expenses before you even apply the percentage. The maximum expenses you can use are $3,000 for one qualifying person or $6,000 for two or more. So if a couple pays $9,600 for two kids, they still only plug in $6,000. On the exam, they love asking for qualified expenses used to compute the credit, not the amount actually paid. The credit is a percentage of those capped expenses. The percentage ranges from 20% to 35%, depending on income, with 35% being the maximum. You don't need to memorize every bracket for many questions. Often they just test that it's a percentage and that the expense cap applies first. Also reduce qualified expenses by any dependent care benefits that were reimbursed pre-tax, like a dependent care FSA. What expenses count? Think care, not education. Preschool below kindergarten can qualify. Before and after school care can qualify even for kids in K-12 because it's still supervision, so you can work. Day camp usually qualifies, but overnight camp does not. Adult daycare and supportive care for a disabled person can qualify. Some transportation can qualify, but only when it's provided by the care provider to get the person to or from care. More non-qualifying traps. Tuition for kindergarten and above is out, even if it's private school with extended hours. Summer school and tutoring are out. Food, clothing, and entertainment are out unless they're incidental and can't be separated from the care cost. And a forfeited deposit is not care, so it's out. On the EA exam, they'll mix one good expense with 3 education expenses and see if you can separate them. Finally, married filing separately is usually a deal breaker for this credit, but there's a special exception where you can still use Form 2441. You must live apart from your spouse during the last 6 months of the year. Your home must be the qualifying person's home for more than half the year, and you must pay more than half the cost of keeping up that home. That's basically separated, maintaining the home and caring for the qualifying person. Diana works full-time, is unmarried, and has 3 minor children plus an adult daughter, Marisol, age 27, who is completely disabled. Her expenses are daycare for Noah, age 9, $2,200. Summer camp for Caleb, age 15, $600. Daycare for Marisol, $3,250. And daycare for Owen, age 13, $1,200. What total expenses qualify for the child and dependent care credit before any credit limitations? Think about it. The answer is $5,450. Noah is under 13 when care is provided, so his $2,200 counts. Marisol is disabled, so her $3,250 counts even though she's 27. Caleb is 15 and not disabled, so he's not a qualifying person, and Owen is age 13, which fails the under 13 test. The tempting wrong move is counting Owen just because he's a minor. Layla is unmarried with 1 dependent child, age 7. She earned $40,000 in wages working full-time. Which item could prevent her from qualifying for the child and dependent care credit? Using more than one care provider, not identifying the care provider on the return, having more than $5,000 of unearned income, or living outside the US for more than 6 months? Think about it. The correct choice is not identifying the care provider on the tax return. For Form 2441, you generally must provide the provider's name, address, and taxpayer ID number, or show you tried to get it. Using multiple providers is fine. unearned income doesn't automatically disqualify you, and living outside the US isn't the key issue here. The provider identification requirement is.